Hi, my name is Rich Stang. I'm a CPA and tax advisor for Northwest Tax Group, a subsidiary of Northwest Federal based in Herndon, Virginia. In this video, I'm going to cover basic tax-related facts, current tax rates and brackets, and some of the major tax laws that are applicable to the majority of taxpayers. Since tax information is complex and needs vary so much by individual, I'm providing a high-level view in this video. If you have specific questions or need the help of a professional, we are available to assist you with tax preparation and planning in our Herndon office or at Northwest Federal's Vienna branch. Feel free to make an appointment by visiting nwtgllc.com and completing the form on the Contact Us page. Let's start off with a review of 2019 tax laws for individuals. Some of the changes in the new tax law that have come up will follow. One is the expansion of the standard deduction. The standard deduction in 2019 will be $12,200 for single filers and $24,400 for joint filers, married joint filers. That includes personal exemptions as well, so personal exemptions have been eliminated. Many more people are now itemizing with the expansion of the standard deduction. The child tax credit has been increased. It used to be $1,000 per child who was under age 17. Now that tax credit is $2,000. Even more importantly is the fact that the child tax credit is available for married filers with adjusted gross income up to $400,000. That's a big increase from the old tax law. Mortgage interest has been changed a little bit. Mortgage interest is capped on debt of up to $750,000. What that means is that if your acquisition indebtedness on your mortgage is more than $750,000, it's possible that you wouldn't be able to write off all of your mortgage interest. That would apply to both first homes and second homes, but the total debt cannot exceed $750,000. Taxes are capped for those who do itemize at $10,000. That is your real estate taxes, your state and local taxes, and your personal property taxes. I know many people were hit by this cap last year and lost certain deductions that they were used to receiving. Medical expenses are still a deduction, but they do have to exceed 7.5% of your adjusted gross income before you can deduct anything. So you add up all of your out-of-pocket medical expenses, subtract 7.5% of your adjusted gross income, and whatever remains is potentially a deduction if you are itemizing. For those of you that don't get credit for the child credit, that's $2,000 because your child is 17 or older, or perhaps you claim a parent as a dependent. There is now a credit for non-child dependents that is $500. The Affordable Care Act mandate, we used to have to answer that question on the return that said, do you have health insurance? The mandate for health insurance has now been repealed. So the question that you were answering previously, did you have health insurance, will no longer be there. There is a new question on the return, though, that you'll have to answer that asks you if you had any activity with virtual currencies. Bitcoin. Did you sell or exchange any Bitcoin? And you do have to answer that question yes or no. For businesses or those who have interests in a business, there is a deduction called the Qualified Business Income Deduction, where business owners or those that are invested in a business can potentially write off 20% of their net business income. If you're a consultant and you had $100,000 of net income, it's possible that you can write off $20,000 of that net income. There are many caveats and restrictions on that, but you'd have to look at that for each person. The alternative minimum tax has basically been eliminated. While it does exist, since the new tax law, very, very few returns are impacted by the alternative minimum tax. Hopefully many of you had a pleasant surprise from that last year when you realized there wasn't any alternative minimum tax. The estate tax exemption has been doubled. And I'll cover estate taxes in just a second, but most of us can now pass, as a married couple, almost $24 million of assets to our heirs without any estate tax. A single person, that number would be about $12 million. And the alimony deduction has been repealed after 2018. That means that any divorce finalized January 1, 2019 or after, if anyone is paying alimony, the alimony is no longer deductible by the person who pays it, and it's also not included as income by the person who receives it. I did want to talk about tax brackets and rates. I get a lot of questions from people who want to know what tax bracket they're in, how does that impact them. The tax rates are graduated. On a certain level of income, you might pay 10%. On the next level of income, you would pay 12%. On another level, 22%. It's important to know what tax bracket you're in, because then you know how much an additional dollar of income is going to cost you in tax, and you would know how much an additional dollar of deduction will save you in tax. There really isn't any way to help your planning unless you know what tax bracket you're in. You should take a look at the tax bracket schedule to see where you are as far as your tax bracket. I know that many of you are concerned about estate tax. What we know right now is that most individuals will not be subject to any estate tax. If you live in Virginia, Virginia does not have any estate tax at the state level, and the federal estate tax exemption is now $11,400,000 per person in 2019. So almost $23 million for a married couple. The tax rate for any assets over that amount is 40%. I do get a lot of questions about gifts. The annual gift tax exclusion is $15,000 per person in 2020. Any person that you give a gift to up to $15,000, there really is no reporting that you have to do on that gift. Congress has also revived the portability of the estate tax exemption, so that if one spouse has passed away and didn't use the full amount of their $11,400,000 exclusion, any unused portion would then transfer to their spouse by filing a very short informational return. And there's also one other break for businesses. If in fact you were subject to estate tax, there is the ability to pay in installments if you have business interests. That's just to help those with closely held businesses not have to have a rush sale of their business. So if you do own a business, there's some help from that standpoint. The other question I get quite a bit is about gifting. A lot of individuals are interested in potentially making a gift to children to help them with the down payment on a house. Even though I said that the gift limit is $15,000 per person, that's without doing any reporting at all. If you give a larger gift, it can generally be done without paying any tax. There is just some reporting that you have to do to the IRS if you wanted to make a gift that was larger than $15,000. For many of us, it's a wonderful feeling to give to charitable organizations. However, since many people are no longer itemizing, there is some planning around how to give to charity to make it tax efficient. One way to be tax efficient is to look into donor advised funds. That's where you would give a large amount to a fund in one year and then use that money to make charitable donations over the next few years. If you gave a large contribution to a donor advised fund that you plan to use over a few years to fund your charities, you can deduct the full amount that you give in the year it's transferred to the fund as a charitable deduction. Another way for those who are receiving required minimum distributions from their IRAs is to use something called a qualified charitable distribution. That's where you would instruct the custodian of your IRA to send money directly to the charity instead of giving it to you as a distribution. the amount that you give directly to a charity would not be considered taxable income. So for those of you that receive IRA distributions and also use the standard deduction, that would be a way for you to give to charity and also not pay as much tax on your IRA distribution. And then one other provision is to donate appreciated securities. The stock market has been doing very well lately, and by giving appreciated stock to a charity, instead of selling the stock and paying the capital gains tax, you're able to deduct the full value of the stock as you give it to the charity, and you avoid paying the capital gains tax when you sell the stock. Another feature is to set up a charitable annuity. That one is very, very complicated, but it does give you a mechanism to create an income stream for earmarking money to a charity when you die, while you do get a charitable deduction when you create the annuity. For homeowners, the mortgage interest deduction, as we talked about, is still a valid deduction, but the amount of your debt cannot exceed $750,000. There was also a provision in the new tax law that got a lot of notice where it said you could no longer deduct interest on a home equity loan. If you used a home equity loan to buy a new car or to take a vacation, that is true. The interest on that money would not be deductible. But if you're using a home equity loan to improve your house, that interest is still deductible. Another thing to focus on is employer-sponsored retirement plans, 401ks or the thrift plan. In 2020, the pre-tax contributions you make to those 401k plans will reduce your income, your adjusted gross income, your taxable income. Up to, in 2020, $19,500 if you're under 50, and with a catch-up deduction, if you're 50 or older, the total can be $26,000. But the more important part of the employer-sponsored retirement plans is most employers do match what you contribute. A good example is if you contribute 6%, your employer might match 3%. If you contribute nothing, the employer matches nothing. So if you think about that, the employer is giving you a 50% return on your money with that 3% match. So for those that are just starting out, maybe $19,500 is a little bit of a stretch as to how much you can defer, but we always advise that someone would want to defer at least as much to make sure that they get the maximum match that they can get from their employer. I also wanted to bring to your attention a new provision that has just passed recently, called Setting Every Community Up for Retirement Enhancement. It's also known as the SECURE Act. It was passed in late December as part of the spending bill. A couple of different provisions there I think everybody needs to pay attention to. One is that the required minimum distribution age for IRAs has now changed from 70 and a half to age 72. That is effective January 1st, 2020. So if you turn 70 and a half in 2019, therefore you won't be 72 in 2020, because you were required to start your distribution in 19, you now have to continue that. But for those turning 70 and a half after 2020, you can elect to wait until age 72 now before you start your required minimum distribution. I think a more important provision is that they have removed the ability to do what are known as stretch IRAs for inherited IRAs. So a lot of people, when they pass away, they leave the IRA to their spouse, then the spouse will leave the IRA to children, typically. Once a non-spouse inherits your IRA, subject to a couple of exceptions, but once a non-spouse inherits your IRA, that non-spouse is required to liquidate the IRA over a 10-year period. I think that's going to lead to a lot of increased tax for those children that are inheriting the IRA. So what we're finding and talking to some people about is whether or not before they pass away they want to convert their IRAs to a Roth IRA. That is a taxable event, but some people are looking at that because of this new rule that says you have to clean the IRA out in 10 years. That's all for today's video. I hope this information helps you minimize your taxes this year and with your general tax efficiency planning. Finding ways to be tax efficient is one part of a holistic financial strategy. Northwest Tax Group is a sister company to Northwest Financial Advisors, Northwest Insurance Agency, and Northwest Title and Escrow, and all of our teams work together along with Northwest Federal to help you manage your financial life. I encourage you to take advantage of the valuable resources the Northwest Federal family offers you. If you'd like a copy of our full tax strategies presentation, please email info@nwtgllc.com and we'll be happy to send it to you. Thanks for watching.